Hello everybody and welcome to this masterclass on private equity and investment funds. My colleague Matt and I are delighted to be running this session for you, and we hope that you'll find this masterclass informative and get involved in the conversation. By the end of this masterclass, we've got a couple of aims for you as attendees. So there are three key things that you should know. The first one is by the end of this, you'll know how to break into this practice area. The second is that you'll know what the solicitors in this area, their work involves. And the third and final one is to know the issues facing this practice area right now. So I'm going to pass over to my colleague Matt and the other panelists in just a moment, but first I'm going to quickly run through some house rules. First and foremost, please use the online question tool to post any questions that you have for our speakers, and Matt will be posing them throughout the session. Please also use the chat function if you have any audio or visual problems during the masterclass, and we'll do our best to help you. Please note that the masterclass will be recorded, and a recording of the session will be sent to all registrants after the session and will also be available on our YouTube channel shortly. Please feel free to post about this masterclass on social media using hashtag #LCMMasterclass. And finally, we have so many incredible masterclasses coming up over the rest of the autumn term. So our next one is going to be on commercial awareness, and there will be a link to register for that in the follow-up email. Okay, just before we get things underway, I'm going to start by finding out where everybody is from. So I'm going to launch a poll, and if you could all fill that out and let us know what stage you're at in your legal journey. So thank you very much. This kind of just helps our panelists and Matt understand where you're all coming from today. I'm now going to pass over to my colleague Matt and to the other panelists. Over to you.
Great, thank you very much, Neve. Welcome everybody this afternoon. There's a good bumper crop of people attending today, so that's good to see. And thank you, of course, in particular to our panelists today. What I'm going to do first, could I ask each of the panelists to introduce themselves very briefly. We're going to get onto your full story in a minute, but most importantly, also say a few words about your firm, because clearly these are fantastic firms that all the viewers are going to be wanting to consider applying to. So let's start with on my screen I've got Xavier first, so let's go with you first.
Yeah, hi everyone, I'm Xavier. I'm a third seat trainee at Weil. I did structured finance in my first seat, private equity infrastructure finance in my second seat. I'm now in the private equity M&A team in Weil. We have 10 practice areas, and sort of mostly the firm is targets private equity and restructuring as our main practice areas, and then of the other practice areas, they're sort of largely geared towards PE. So we have a big finance team. A lot of it is leveraged finance, which is finance in the context of a PE deal, and then our specialist teams such as tax, employment, IP, again focus on those specialities within the context of private equity. And then the restructuring team is slightly more sort of siloed, less in a PE context, and that's more of a standalone team, but it's one of our big practice areas as well. And yeah.
Great, thank you very much. Heidi.
Hi everyone. Nice to meet everyone. My name is Heidi. I'm an associate at White & Case in our private equity practice group. White & Case is a global US-led firm, and we have offices around the world. White & Case is also a full-service firm led by corporate and PE and the likes, but definitely a full-service firm and covering various jurisdictions.
Great, thank you. And finally, James.
Hi everyone, nice to see everyone. My name is James, and I am a senior counsel at Travers Smith. I've been at Travers for about 9 years now. I haven't worked at another law firm, so I can't really compare, but I think Travers is great, hence why I've been here for so long. We are an international firm, but based in London, full service, like White & Case. So we have everything from corporate to finance, employment, tax, you name it. I originally qualified into the private equity team as a corporate M&A lawyer, acting for PE firms, buying and selling businesses. The focus was on funds deploying capital that they had raised I moved into secondaries past a couple of years ago. So instead of buying and selling assets held by private equity funds, I now help institutional investors buy and sell interests in private equity funds. And I also focus on GP-led continuation fund transactions as well.
Great, thank you very much, all of you. So we'll get back to some of the those bits that James was just talking about. But Heidi, first, maybe you could just give us a real sort of private equity 101. What does that actually mean, and what's the scope of this phrase?
No, I think that's actually a really good question, and I'm sure the answer depends on who's going to give it. But from my perspective, and what we do in our private equity practice group at Weil Case, is that all of us are corporate lawyers and transaction lawyers in specific, meaning that we help our clients, who are mostly private equity funds, to buy and sell assets. And that's what I would say is the 101. And then the next level is what James has briefly mentioned, is given that our clients are private equity funds, then the fund piece as to how that works is another specific part of private equity, and what separates that from so to say, just M&A work for corporates. So it's the type of clients and what comes with that I think separates private equity from just corporate M&A.
Okay, and so in an M&A transaction, you basically, it's somebody buying, somebody selling, and so what's the real sort of nuts and bolts of that? What, as you say, why is that different from M&A? We'll get to talking about where funds come from with James in a second, but I mean, can you just give us a very brief outline of how and why a transaction happens?
Sure. Shall I go?
Yeah, please.
Okay. So, sorry.
Sorry, continue, Kel.
So how that happens is it always depends on from which side of the transaction you're looking at things. So our clients, the private equity firms, you might end up acting on the buy side, or you might end up acting on the sell side. So starting briefly on the buy side. So typically what happens is that a private equity client will say that, hey, we've been looking at this asset and we're quite keen to look at it in more detail and see if that would be something for us. And when the asset comes to market, then they will reach out, or often, of course, there's a arranged process as well from the sellers. And then effectively, on a high level, what happens is that the client will get into the detail of the asset, seeing what due diligence they need to make sure that they understand how the asset works. Then we will move on to negotiating transaction documents, and depending on how the transaction is structured, the documentation differs a bit. And then when everyone is ready to sign on the dotted line, so that takes you to signing, and then you will typically need certain regulatory approvals before your client will actually hold the shares, which we then call closing. That's typically what we do on the buy side, and then once the private equity house has acquired the asset, then depending on how their fund works, they will hold on to the asset for between 3 to 7 years, or some funds even longer, in order to make the returns that they want to make, and then they will look to sell the asset. And sell side is always, I feel, a bit longer process, because you want, when your client is selling an asset, you really need to plan the sale process really well, identify any risks that might come up in the sale process to preempt any issues that buyers might raise and try to chip the price. So you prepare really well, legal due diligence reports, documentation for the sale, and then you launch the process and effectively do everything as I said, for the buy side, but says you're a negotiator on the other side of the table.
Okay. Now, of course, I guess when you're doing the buy side, you're always acting for a PE firm. If you're doing the selling, either you could be a PE firm that already owns an asset selling it to another PE firm, or you could be an asset that's being sold for the first time. Now, do you guys act for those kind of clients as well, or are you mainly acting just for the PE houses?
Yeah, I mean, I can take this, Heidi, just
Okay,
from the Travers view. I mean, mostly it's on the M&A side. It's acting for private equity firms buying and selling, but sometimes you do get a scenario where some founders or a founder has grown a business and scaled a business to a certain level and a certain stage in its growth story, where private equity investment then makes sense. And we often will act for those founders of those more mature businesses when they're selling to private equity. And Heidi's nodding and Xavier's nodding as well, because I assume that they do the same thing, and it's certainly very helpful from a legal perspective to see both sides of the story.
And then okay. James, just to add, then there's also like what we call take privates, that there might be a public company that a private equity house wants to, so to say, take private, i.e. Buy it. So that's another scenario.
Okay, great. Now, I guess we've talked quite a few times about private equity firms, private equity houses. James, what are they and why do they exist, and where does the money come from?
Great question. Another very expansive question, Matthew. So
be my guest.
So private equity funds are effectively just pools of capital, managed by what we call a GP or a manager, or a private equity firm. Now, what happens is that private equity firm or that GP or manager raises that capital from third parties. They could be sovereign wealth funds, pension funds, other institutional investors, sometimes high net worth individuals, and those investors are in a fund context. They are known as LPs, limited partners. And so you've got the LPs, and then you've got the GP, which is the private equity firm. And the deal that the LPs and the GP make is that the GP says, if you commit capital to my fund, I will deploy that capital buying really great businesses, and then I will grow those businesses in value, and then I will sell those businesses for more than I paid, and then I will distribute capital back up to you, such that you, as the LPs, whatever you've committed to that fund, you will get your commitment back, plus a coupon or an interest on that, effectively a hurdle, let's say 8%. You'll get your commitment back plus 8%. And if we do really well, and we bought really well, and we sold really well, any excess profit we can share. Me as the GP, I'll take 20%, and you as the LPs, you take 80%. So that's effectively the deal. I guess the other thing, the point to flag, which I think is an interesting one, is when LPs commit capital to a fund, they don't actually provide all the money up front on day one. It's just a paper commitment. So whenever the GP sees a business that they want to buy, they will then draw down from their LPs. They'll go to their LPs and say, hey, we want to buy this business for 100 million. We need 100 million. Can you provide us 100 million in 10 days? They will do. The LPs will do so, and then the GP will use that money. The fund will use that money to buy the business, and then hopefully when the business gets sold, returns go back up to the LPs.
Great. Okay. Well, that's really clear. Just to give, I mean, just before I'm going to move to Xavier in a second to look at maybe at the nitty-gritty of the deal, but how many of these funds are there? Because from what I can see, a lot of it, what is them? They're all buying and selling them to each other. How big is this market?
I mean, I'll have to. Well, I don't have the numbers to hand, but it's ginormous. The fund industry.
Huge.
So each private
Tens of
equity.
thousands?
Yeah, some maybe. I guess the important point to mention is that each private equity firm might have various different funds and various different strategies. You know, a lot of private equity funds are becoming alternative asset managers that cover not only private equity but credit and real estate and infrastructure. And within those strategies, they'll have multiple funds. So you're talking billions, if not trillions, of dollars that are being funneled from institutional investors, pension funds, sovereign wealth funds into these private equity, private market funds. And of course, it's a virtuous circle. So all of our pension money that we contribute, or hopefully, contribute every month, will go to a pension fund, and then that pension fund will invest some of that into private equity funds themselves.
Great, thank you.
I think
So-
if I may, Matt, just one thing to add there is I think people sometimes don't realise how much of what they look at on the high street is owned by private equity, because once a company is bought by a PE fund, they don't put their logo on there. But if you walk down the high street, so many of the shops and bits of infrastructure you see are owned by PE firms, even though their logo is not on there. I think Poundland used to be owned by one of the biggest private equity firms in the world, and sort of people don't realise that because they don't put their logo next to it. But if you sort of deep dive it, you'll realise an enormous amount of assets, both sort of high street, infrastructure, sports, real estate, as James mentioned, are owned by private equity firms.
Okay, I mean, it seems to me once they're into the PE world, they don't really emerge back out the other side unless something radical happens. They continue to be passed around. Is that a reasonable assumption?
I mean, I think what I would say, Matt, is that private equity is effectively just a source of capital for growing businesses. And so, the reason why Xavier made the great point that a lot of the companies and businesses and brands that we know on the high street are actually ultimately owned by private equity is that, these companies have a choice. They can get investment from banks, or they can get strategic investment from private equity to take them to the next level. So it's a really important source of capital for our economy and all the businesses that they hold, and therefore all of the employees of those portfolio businesses as well.
Sure, great. Okay, Xavier, we're hearing about all these loads of deals happening. Let's go down to not quite so micro level, but the individual deal level. Can you tell me either from the buy or the sell position, what would a team from within a law firm look like as far as the composition of who's involved, how many other matters they're dealing with at the same time, and what the different bits of the job are done by different players within your team?
Sure. So we've started a process recently where it's not a full sale transaction. It's a 10% co-investment into one of our corporate clients, but that 10% will represent a very large figure. So it's a pretty sort of major deal for us, and it's just got running in the last week or so. So we're doing sort of vendor side due diligence at the moment, and sort of the main corporate team consists of 6 of us. So a partner, 2 associates, an NQ, so sort of a junior associate, and then 2 trainees. And we're sort of currently going through all the corporate documents that have been uploaded into the data room. So the company will sort of go through all of their documents they have on their sort of system, anything that might be material or anything at all really, they empty into this data room, and then it's the job of the sell side counsel, so ourselves in this case, sort of go through and make what we call a vendor side due diligence report. We then sort of hand that over to all the potential investors and access to the data room, and they go through all of that themselves. So currently the team is the 5 of us doing the sort of corporate side of things, and then we have our various specialist teams looking into sort of non-corporate law areas of the documents that have been uploaded. So we have our real estate team looking through all the leases and freehold sort of title documents of title. Our litigation team is going through any sort of ongoing or pending claims to sort of see whether any of those might be material and affect whether a co-investor would want to invest. We have our finance team going through all the sort of existing financing arrangements of the company just to make sure there's no change of control provisions, which could essentially sort of blow up that financing. And we have our IP team going through all the existing intellectual property. So there's sort of the main corporate team, and then sort of, I think I mentioned 4 or 5 separate teams, probably consisting of 2 or 3 people each, going through, and we're creating this report. And it's the job of the trainee, so that in this case is myself, to gather all of the sort of initial questions that we have, both from our corporate team doing sort of main corporate side of the diligence, plus all of our specialist teams. There's no local counsel in this one so far. Sort of gather all those questions together, and we'll send those on to management of the company, and then they'll sort of provide their sort of answers to that, and then sort of the report will get progressed. So that's sort of the initial stage we're at the moment in the diligence phase. So all in all, it's probably about 16, 17 people on this, which sounds like a lot, but when you're investing in such a large company with such a vast variety of assets, and sort of, you know, existing financing IP, you really need also the different specialists to weigh in. You can't just get the corporate team to do it. So that's sort of what I mentioned earlier at the start. Our sort of IP people do IP in this context, in the context of diligencing transactions. So that's sort of the first phase. Then once you finish your DD process and you're sort of negotiating the long form transaction documents, as Heidi mentioned earlier, then the sort of rest of the team sort of largely drop out unless you sort of require them to specifically look at something, and it's the corporate team negotiating with the corporate team of the potential purchaser or co-investor. There's sort of a load of other, so that'll be your sort of SPA, typically your sale and purchase agreement or share purchase agreement if it's shares. And then there'll be a sort of host of ancillary documents, which is where the trainees can potentially get involved with drafting. So things like disclosure letters, drafting particular warranties, and sort of hopefully down the line, that's what I'll be doing. And yeah, so that will be sort of the main corporate team of 5 or 6 of you, sometimes less. In this case, the sort of people who are diligencing it might fall away, and it will become sort of 3 members of the corporate team, a partner, associate, trainee, or 2 associates perhaps, and that will be sort of the next stage of that.
Okay, so lots of balls in the air simultaneously. And just on your sort of on the sort of daily process, like for say in the due diligence process, are you're doing some of the due diligence reporting back, or are you locked in Purda for a week or 2 at a time, doing absolutely everything and coming out for light at the other end? How does that work?
Yeah, so the DD process, and everyone's locked in. We'll be working very hard for the next 2 weeks. There's no getting away from that. My task is sort of partly I am doing part of the reviewing of the existing minority investments or sort of non-wholly owned subsidiaries of the company where the investment is going to be going into. So that involves going through the existing sort of shareholding agreements and articles of association for the companies in which that top company has invested into, to see if there's anything that could be triggered by a 10% co-investment higher up the chain, which is something that a co-investor would want to know. That's part of the diligence I'm doing, and sort of knocking up part of the report itself. And then at the same time, at the end of the day, I ask the specialist teams to sort of send over any questions that have come to their mind during the course of the day. I then add those to the questionnaire I've got running. And then at the end of the week, that would be going across. It doesn't go every day, but at the end of the week, that would be going across to the company itself for the managers to have a look at. And once it goes there, they'll also then split that up into the relevant sort of specialist areas and get those answers, and they'll come back to us on that next week.
Great, thank you. So Heidi, I guess we're hearing all these deals serenely proceeding brilliantly. What are some of the things that can go wrong that makes a deal not happen?
I think if the deal has started, I think it's very rare that anything comes up in due diligence which is like a showstopper. Things will come up which the buyer will want to reflect, for example, in the price or get contractual protection in the transaction documents, but quite rarely once the deal has gone forward, anything like that comes up that is a massive roadblock and that can't be solved. I think it's more that in the early stages when the PE houses are looking at the asset, that's when they're looking at the commercials and whether it fits their investment strategy, whether they think that they can make the profits that they want to make. It's that early stage when they're looking at the commercials when they might decide this asset is not for us. But once they've decided, then I don't think,
there in the way you go.
I don't know, James or Xavier, if you've ever seen that anything comes up in diligence that is a showstopper. I mean, often you just find a negotiation position in those situations.
Okay, well that makes sense. So I guess that we've got sort of two more stages, and I'm going to ask you firstly about the sort of the hold stage, and then I'm going to ask James about the disposal stage, and sometimes how other things than just straight disposal happens. But what are you guys still involved? Having done this deal, are you guys still involved while the asset is being held by its new PE owners?
Yeah, so in our team, we have a couple of people who are so to say specializing in the hold period, so that our firm wants to cover the whole life cycle of the investment, the acquisition, the whole period, and the exit. So we have people who are doing that and basically looking after portfolio companies of our clients. So their kind of day-to-day work is then support where needed the portfolio companies. For example, when further equity injections are needed, they will do the corporate documentation, where a manager who is part of the management incentive plan, for example, for some reason exits the business, you will need to ensure that they have an exit package, or there's, for example, a massively important commercial contract that needs to be renegotiated. They might help with that. Yeah, so basically our portfolio team, so to say, will help during the hold period and get involved in the asset management where the client feels like perhaps their in-house or the target's in-house team need support.
Okay, so basically you're still there looking out for the interests of your client and keeping the wheels turning, which will then ultimately take us to exit. So James, what happens at exit? How, when and why does it happen?
So the reason why PE funds don't just hold assets forever and they actually want to exit those investments is because private equity funds tend to have a limited fund life. They tend to be 10 years plus 1 or 2 years, but call it 10 years. And in those 10 years, pursuant to the limited partnership agreement, the deal between the LPs and the GP, is that in the first 5 years, the GP will take the money from the capital from the LPs and buy different great businesses. And then in the last 5 years, they will then sell those businesses to various different through various different routes. So that is why ultimately exits happen and why companies are eventually sold. Now, traditionally, private equity funds or firms had a few exit routes. They could grow the business to such an extent that they would be able to IPO that business on a regulated market. They might sell the business to another private equity firm, or they might actually sell that private equity business or the business that they hold to a large corporate. They tended to be the 3 exit routes. Now, there is this thing called the secondaries market, which has created another exit route for private equity firms. So if they don't want to IPO it, or it's not ready, if they don't want to sell to another private equity firm or a competitor, or it's not right to sell to a corporate or a trade buyer, then they might actually the GP might set up a new fund known as a continuation fund, and it would be that continuation fund that would acquire the business. Now, there's lots of drivers for those continuation fund deals, but a couple of the drivers I'll just run through means that the GP can hold on to the asset for longer. Perhaps that asset is that business, they're 75% the way through a business plan execution, and they haven't actually got to that to 100% of that. Perhaps it's a consolidation play and they bought the business originally to buy other businesses and they haven't found the right businesses to buy. So the GP needs more time and more capital to buy other add-on businesses. Maybe the GP's LPs have held the business for quite some time and they actually want some liquidity. They want a distribution, but at the same time, the GP doesn't want to sell this business to a competitor. So why not flip it into a continuation fund? So that it's becoming a fourth exit route in the GP toolbox.
And that's basically selling it to yourselves.
Yes. Now it's selling it to yourself in the sense that the GP manages the selling fund, but also manages the continuation fund. The crucial bit to flag, though, is that some of the investors in the continuation fund might be other third-party investors that wouldn't also be in the selling fund. So the GP might actually go to market and say, we've got this incredible asset, we don't want to sell it to a competitor, it needs a bit more time, needs more capital, and market that asset to a specialist secondaries investor who will capitalize the continuation fund or commit a big chunk of capital to the continuation fund to help the GP buy that asset. So structured well, it is this selling to yourself. It can be a win-win for all the stakeholders.
Yeah, so
Right, okay.
it doesn't mean that they're gonna sell it for £1. It's not like it's not a scheme that works that way.
Okay, great.
Right.
So yeah, so I think we've got a good feel for how the process works, what happens. I guess one thing to ask, and Xavier, you sort of started on this, but I'll come back to you on this. But you know, where does PE sit in the rest of the firm, and are different firms different? I think my understanding is Weil is very PE led. And you know, that's the primary game. So is that the case? That I understand is the case there. But what about other firms? And you know, or maybe reiterate what you're saying there, and we can ask the others how that works, or what examples they can give.
Yeah, I think at a while, sort of James and Heidi both mentioned that their firm's sort of full service. I don't think we would describe ourselves that way. We have sort of 10 distinct, we sort of have 10 practice areas you can sit in as a trainee, and really sort of 6 or 7 of them are PE or things that are very closely connected. So that is our bread and butter. Like as a trainee at Weil, like you will sit in the private equity team at one point. Is almost 100% certainty. Whereas with other law firms that have maybe 30 seats or more, that's maybe not a guarantee. And you sort of maybe have to sort of bang on the door a bit more if you really want to do corporate work. Whereas with Weil, sort of you will end up doing that seat.
Okay.
So our PE team is our biggest team. I think we've got 60 in total in London, and the other team sort of spurt out of that really. Sure.
So really, thinking about one of the objectives of this, if you want to get into PE, plan number one is find a firm that really leads on PE, and then apply there, because you won't be able to get away from it. Heidi or James, I mean, again, I guess you've got other departments within the firm that you interact with. Are those again getting all their work from you, or are they, or is it a bit more of a balance? Heidi, maybe.
Well, I think effectively what Xavier explained about how specialists in employment, tax, and so on or real estate. Yes, they will be supporting corporate practices, whether that's corporate M&A or private equity M&A. But they will have some of their own work as well. But for sure, a big part of the work will be supporting the corporate piece of the firm. And then, of course, like Weil & Case has a big litigation arbitration department, big financing department. those departments will definitely have their own cases and work as well, and they are not just to support corporate teams, but will of course do so when needed.
Okay, yeah. So there's always a corporate angle lurking around the corner for quite a lot of practice areas.
Yeah.
I mean, maybe
yeah.
you could, sorry, I mean, just again, in the interest of understanding how people end up where they are, maybe you could just remind us what your journey into working in this area was. I don't think we actually ever did that in any detail.
No, so I mentioned that White & Case is a global firm. So I started with White & Case in Finland, where I'm originally from, in 2015. And then I moved to London on a firm internal secondment in 2019. And I was doing corporate M&A in Finland already. So it just turned out that in London there was a need for a person in the P side of things. So it's just part of the wider corporate group. So that's how I ended up in our private equity team in London. Recently, I've done a client secondment with Anton Infrastructure Partners, which is a private equity fund specialized in infrastructure. But I think for me, if you do corporate work, in most firms, you will end up probably working with private equity clients anyway. Of course, you will have separately people specializing in public M&A, because that's a bit of a different breed from private M&A. But otherwise, if you just look for opportunities in corporate M&A piece, then hopefully there will be an opportunity to work with PE clients as well.
Okay, and just back to your secondment, what insights did you get from being maybe the other side of the fence to better understand what clients want and need?
Yeah, I think that's a really good question, and I think it is really eye-opening in a way, that seeing from the client perspective, that just because you're at private practice, you might be doing one deal with them. It's just they are doing so many other things, that they're doing other deals, and also they are managing their portfolio companies and supporting them, which is also quite time consuming. So just seeing the variety of things that come up as an in-house counsel in a private equity firm is just, you realize that in private practice you were like, oh, I thought we're doing this deal, and that would be the majority of what you're doing right now, but there's always the piece of supporting the portfolio companies and getting involved in a lot of things. So yeah, just eyes opening for sure.
Great. And James, I think you did a secondment at some point in your career as well. Is that right? How did that influence how you progressed in your journey?
Yeah, I mean, I think secondments are awesome opportunities. So if anyone gets an opportunity to do a secondment, you should definitely stick your hand up and grab it. As Heidi said, it's a great way of really seeing how our clients interact, what they really care about. So I was fortunate enough to be seconded to EQT Credit. They had a credit platform, and they were spinning that out to another asset manager, happened to be Bridgepoint, and so I was working within the target, if you will, helping them with the transaction, which was a carve out effectively from a larger fund manager. And then I moved over to Bridgepoint, so I kind of got two for the price of one, and managed to see what Bridgepoint was like and also what EQT was like. So yeah, they're great opportunities to go for.
Great. Okay. Well, we're going to go to your quick case study, though I feel like we might have trodden on some of the water there already. But one thing we also I guess should be wanting to know is what's everybody in the PE industry really sort of thinking about right now? I mean, Xavier, from your point of view, what do you think the trends are? What are the partners that you're working with sort of excited about, worried about? Where do you see this market being going as you mature as a lawyer and move up the chain?
I think at the moment, because of interest rates, there's not a huge amount of LB activity going on, or it's sort of certainly slowed over the past, sort of as compared to this time last year and this time 2 years ago. So a lot of what we're sort of doing at the moment is something Heidi mentioned, touched on earlier, is management incentive plans. So that's something you'll happen where you'll sort of complete your transaction, the PE firm will buy X company, but part of the value of that is in the managers themselves who are there. So if they all just up and leave, suddenly you're got a business, but you don't have any of the talented people who work there. So one thing lots of PE firms are doing at the moment is trying to sort of get their MIPs, as they get called, sort of up and running if they haven't already done them. So typically those follow a transaction sort of closing, and what you do is you give the managers the opportunity to hold shares in the sort of top co entity itself, which is where sort of money flows up and eventually gets distributed, sort of as James mentioned earlier, to the LPs. So that's a way of incentivizing managers to stay, and eventually they can take their piece when the company gets sold by the PE firm down the line at the end of the holding period. So there's quite a lot of that going on. I'm on a few of those processes at the moment because there's not sort of a huge amount of big glorious LBO activity going on at the moment. So lots of PE firms are trying to sort of incentivize and strengthen their sort of current holdings in companies by doing things such as MIPs. So I think until interest rates come down, maybe next year, maybe the year afterwards, and there'll be a lot of sort of consolidation of existing holdings via things such as MIPs and possibly bolt-ons, which is where the company you've purchased itself purchases a smaller company, sort of help build that company that way, rather than just sort of through sort of ongoing strategic performance. So that's called a bolt-on. It's essentially a sort of smaller transaction that happens underneath the main transaction. So there's quite a lot of that going on, and there's quite a lot of management incentive planning going on, as I mentioned.
Great. Okay. I mean, I guess the other thing about this topic, and maybe James is a good person to talk about this, is and where does the casual reader find information about what's going on and what the currents are? I mean, I note from that James, you've got quite a lot of articles on places like Lexology. So what do you write about, and what's the purpose of your writing on these? You're talking really about the talking points, or is it more sort of to attract clients and show that you're the people to go to?
I mean, if anyone wants information about the market, what's happening in private equity, I wouldn't say I'm the #1 source for that, but that is very kind of you, Matt, to suggest that. But yeah, I mean, listen, mainstream business press, there's industry magazines, private equity news. I mean, if you just type in private equity in Google, you get a ton of articles that come up that will come up with similar themes to what Xavier's mentioned. High leverage costs, lower private equity buyout activity, bigger demand or need for private equity firms to really drive value through creative means at the asset level. Investors looking for liquidity via the secondaries market often, and a bigger drive for continuation funds as the M&A market is slightly less buoyant as it previously has been. There is a more of a use case actually to flip certain assets instead of on the open M&A market to a continuation fund where actually you might get a better price. So yeah, there's plenty of materials out there. Lexology is just one of them. But yeah.
Great. So unless you've got any other particular trends that you want to mention to us, Heidi, could we maybe now switch to you and James doing your case study? Just give us a quick 5 minutes on what a typical deal might look like.
Yeah, sure. I'm happy to do that. Actually, James is going to start that.
Okay, sorry.
Yeah. Okay. So we thought we make this interesting and do a bit of role play here, where I'm the sell side lawyers and Heidi represents the buy side lawyers, and so just giving the audience a flavor of the type of deal. So on the sell side, we're acting for a private tech business, which designs and sells software that provides advanced early warning to offices of natural events, for example, earthquakes, that could interrupt operations. So the business is called, obviously this is all hypothetical, business is called Warning Limited, and it's based in the UK. The shareholders are founders and other members of management. The founders want to take on some investment to take the business to the next level and to break into the US market, because it's just UK focused for now. But at the same time, founders want to retain some control over the direction of the business. After all, it's their business, but they also want some liquidity, so to take some cash off the table. And the founders have appointed a corporate finance broker who is running an auction process for the investment. Over to you, Heidi.
Thank you. So then on our side, we're acting on the buy side, and we're representing a private equity firm that is actually looking at opportunities like this in tech space and focusing on climate change. And this our client has recently raised a new fund to invest in this space. So this is coming at the right time, and they're very keen. And this corporate finance broker has reached out and said that there's this opportunity coming up, which our client is keen to look at, and they will have signed a confidentiality agreement to get access to the virtual data room to look at documents and kick off their due diligence and we are as we're representing our clients, so we're doing the legal due diligence and coordinating with other advisors to look at technical stuff and other financial diligence and other points. And also, given that our client is using money and time and effort to look into the asset, they've also entered into an exclusivity agreement to make sure that that James's client is not sneakily speaking to somebody else, and then they will buy the asset that we want to invest in.
So Heidi's firm has locked us in, and so we've got exclusivity with the potential buyer. Who are the parties that we've mentioned already? You've got the founders of the target, so that's on the sell side. You've got the management team of the target, again on the sell side. You've got the private equity firm, which is Heidi's client, on the buy side, and then you've got a whole range of advisors on both sides, legal and other professional advisors that might be helping on the diligence process. So what's everyone trying to achieve? So on the sell side, founders want liquidity when the sale completes and to ensure their cash is not subject to any deferral payment mechanism. They want the cash on day one, but the founders want to retain some control over the future direction of the business, and they want to control how the investment is used in the business to break into this new US market. The founders want to use some of that cash to re-incentivize the next generation of the management team to take the business forward, which is a reference to Xavier's MIPS that he referred to earlier. And in 10 years' time, the founders want to fully exit from the business, retire, and sit on a beach.
Our client, as part of the process, so our client wants to, as part of the due diligence process, they want to understand how the business is working, whether there are any legal, business, or commercial risks in terms of how is the money coming in. They're looking, they're keen to look at the commercial contracts to see how this business actually makes money. Whether there are any potential disputes coming against the target after our client has invested in it, and things like this. Whether the business is compliant with laws as part of the due diligence process. And they also want to understand what are the growth opportunities. How can our client make the profits and that they want to make from this investment, and as part of doing that, they typically want to take a controlling stake of the business, but leaving the minority stake to the founders, because they will need the founders and the management team to actually run the business, because they know how to do it, and and our client will also want to incentivize those people to run the business in accordance with the business plan that they believe in, all jointly. And then eventually they want to understand how to best make sure that this business can be profitably exited in a couple of years, as James pointed out.
And then the final section to close this out, how do we really get there? So on the sell side, we were advising the client on various different legal work streams that be helping the target gather the relevant documentation to put in the virtual data room, prepare the seller or vendor legal due diligence report for this bidder that we've got exclusivity with the help of our specialist teams, responding to due diligence questions from Heidi and her team as she goes through all the documents in the data room to try and understand the business. I would then be drafting the sale documentation, so the SPA, and negotiating that with Heidi as the buyer's lawyer, taking regular instructions from our client. And then finally, we'd be reviewing the equity documentation, the documentation relating to the incentivization, the management incentive plan between the, which will be really the shareholders agreement between the private equity firm buyer, the founders, and the other management members.
And quickly on the buy side, it looks pretty much the same, but is the different side of the coin. So on buy side, our work streams would be undertaking the legal due diligence and reviewing the sale documentation that James has prepared, and ensuring that the terms and conditions are acceptable to our client. And also, as mentioned before, in private equity, it's very typical that you will need that the client wants to utilize debt finance for the acquisition. So we will be liaising with the client on that and see on what terms they will be able to get debt to purchase the asset. And then, of course, as James mentioned, we would be also negotiating the equity documents, which is a shareholders agreement governing as to how the business is going forward, making sure that our client gets the control rights that they need and want, so that they can ensure that the business is going to the direction that they were envisioning.
Great. Okay. Well, thank you very much. That's really instructive and brought it to life. We're getting pretty short on time now. I've got a few questions from the floor. I think we should let's go through first. So Xavier, fairly core question. What's the difference between private equity and venture capital?
Oh, I think venture capital is sort of, when you think of Dragon's Den, that's what people sort of think of. So sort of earlier stage investment. Whereas private equity, and not sort of, you wouldn't see a full sort of 100% buyout. That might be sort of 50% investment from a third party who is banking on sort of big multiples of returns. Whereas PE, typically we're talking about a 100% buyout of all the existing shares from a PE firm, so that the ownership is 100% different. And that will typically be sort of a later stage for a company, rather than venture capital sort of a bit earlier on in the life cycle of a company, and unlikely to be 100% of the share capital.
Great. Okay, thank you. So here's a question that I don't actually understand. Where's it gone?
Let's hear it.
What opportunities arise for law firms with private equity firms resorting to unorthodox methods such as margin loans to release proceeds for their investors?
Yeah,
So
that's.
I think what that question, I might be wrong, that question is trying to ask is in relation to things like NAV facilities, or fund level borrowing. So sometimes private equity funds will put in borrowing at the fund level, and they typically use that's normally called a subscription line, and they typically use that for cash flow purposes, so they don't have to constantly draw down from their investors. They can just use the fund level financing to buy the businesses. but you also have NAV financing, which is financing using the NAV of the fund as collateral. And you can use that for various purposes. Sometimes you just need to put more capital into the portfolio, but there's no capital left in the investors. So you take out NAV financing. Sometimes you try and accelerate liquidity by putting in place fund level financing, which I think is what was driving that question from the audience.
James, and I think if you agree, I think probably the question also touches on, like, there are just so many ways to structure the fund and how it works. There's also so many ways to structure how a private equity investor invests. It can be, as Xavier mentioned, it can be 100% purchase, it can be 80%, it can be by way of actually giving debt, it can be by preference shares. There are different ways to structure it, and often clients will want your help to, depending on the kind of commercial drivers, to help them structure the deal so that it gets them where they want to go.
Great, thank you. Another one here we've got is, could you expand more about the change in control clauses and their importance in the due diligence process?
Oh, Xavier will love this.
Yeah, I think they're extremely important. So if you have your sort of target entity and it's about to sell 51% of its shares, typically that will trigger a change of control clause in lots of the underlying documents. So that might be your sort of main material contracts with suppliers, or it could be sort of financing arrangements. And typically in a change of control, that might entitle the counterparty to sort of terminate the arrangement. So whether that's the sort of supply contract or the financing, which could be sort of pretty disastrous for the company if they sort of don't negotiate a way out of it. So one of the key things you're looking at in diligence is going through and sort of thinking, is this proposed transaction going to trigger a change of control in the material contracts of the business? And if it does, what's the nature of the sort of right of the counterparty? Is it just they get to get around the negotiating table again, or do they have a right to just fully terminate that contract? So if you're a company which is very reliant on one contract, one big material contract, and that could be terminated by way of the sort of sale of 51% of the shares, then that's something you need to flag pretty early on, as it's extremely material. So you see change of control provisions in a lot of contracts, and it's important to sort of flag them and understand really what they're getting at. What's the right of the counterparty?
Great. Okay, we're getting very, very close to the end now. So if we could just ask everybody to give us one quick, what I think probably I'd like to hear today. What's the best thing of working in PE in one sentence? James, you can go first.
The people. It's all about the people. Your private equity, you're surrounded by very, very talented, high-performing individuals that want to effectively just grow businesses and create value.
Okay, great. Heidi.
My answer is you'll never get bored. I get bored easily, but I'm still doing this because you always get different clients, they're looking at different assets. You learn something new all the time even when you're doing diligence, and every deal is different. So for me, definitely, you never get bored, and the people, as James said.
Great, thanks. And Xavier?
I think corporate law is the broadest practice area that you can do, to be honest. I think it's, they say corporate lawyers aren't a specialist, they're sort of a jack of all trades really and master of none. So I think the variety of the work you do in this practice area is the widest. So if you want to face sort of different challenges frequently, or more frequently than might do in other areas, then corporate law is maybe the one for you.
Great. Okay. Well, I think we're at time now. So my thanks to everybody that took part. Needless to put a final survey up on the wall, but thanks for taking part, and thanks to all our panelists.
Yeah, thank you, Matt. I just wanted to reiterate and say thank you so much to everybody today for taking part. If you could just fill out that poll on your screen so we can get an idea of what you've gained from today, then that would be fantastic. And also, before you go, just another reminder to attendees that we'll be sending out a link containing the recording to this session and a link to register for our commercial awareness masterclass. So I'm going to share what you all took from today. Thank you so much to our panelists, thank you to attendees, and we will see you next time.